Morning, everyone. So we have a little pullback today, which I suppose isn't that surprising after a really almost record-breaking day. Just a reminder, everyone, of the disclaimer. So that anything we talk about today is for educational, entertainment, and information purposes only. Up 12% on the NASDAQ. We can see here in the SPY, big rally past that 9 EMA into that little upper SAR. If it hit that SAR, the parabola would have flipped over, would have been uptrending, but it didn't quite get there. I was talking earlier in the day and the day before about how we probably get to between the 9 and the 20, and that's exactly where we got to. I was maybe thinking that we could get just a little pop on the open, just given that incredible strength, but that was too much to ask for. So now we've got a little pullback today as people realize that really this isn't over by any stretch of the imagination. A deal with China would be incredible. We would probably push, that was a lot of this was very, very squeezy. I'm going to talk about one of the big reasons why. But this could get even more squeezy. But for now, we've got a little bit of reprieve. I think we've probably seen the top in VIX for now, related to the things breaking, right? So we weren't getting the stock Fed put, but we kind of got a little bit of a bond put there, right? Trump, his team basically came out and said, listen, we were worried that something could happen. So we were starting to see some concerning things. So now we know there's a bond put. So I think we don't get to 50, 60 VIX at this point. Maybe we do revisit the kind of 5,000, 4,900 again and kind of trade in here a little bit until we get a little bit more clarity on what's happening with tariffs, further ongoings with the tariff. So we can see here, massive realized volatility. This doesn't even include yesterday. So this red line, huge realized volatility, just soaring 100th percentile, almost 100th percentile in 3-month implied volatility. That's just basically option pricing. And really we're seeing that. So if you scan across all single names, pretty much everything's at 100th percentile volatility. So about as high as we've seen it in a year, but really going back a few years in most cases. And these are the ranges we've had lately, right? April 4th, down 6.6%, high to low. April 7th, 9.4% high to low. We had that huge bounce there on the fake news. Turned out the fake news was true. It was just early by a few days. April 8th, 6.9%. And then yesterday, bonkers, NASDAQ up 12% on that relief from the president. So one of the big things that you've got to watch for, and so in the chat, I said, listen, this is, I would not get in the way of this rally. So the news came out and I said, this is pretty big. We got up, and then this sort of data can give you an indication of how these ETFs work, right? These levered ETFs, inverse ETFs work a little bit the same way, but this turned out to be the largest ever rebalancing in the history of these levered ETFs, right? So when we always talk about, listen, the derivatives market, the options market, synthetic gamma, which is, I would say, is this, synthetic gamma is really a big part of movement these days. And you have to kind of pay attention to this stuff. So look at this. We had big bounces in growth, in MAG, in basically growth of all kinds, momentum type names that haven't been doing very well. Some names up 20, 25%, just incredible rallies. And what that does is it creates an incredible imbalance for these products to buy. So when a stock, when an ETF is levered like this 2-3 times, it has to rebalance by the end of the day. So let me show you how that works. Okay, so let's say you've got a stock trading at $100 and it goes up 10%. The 3-time levered version, which have taken in incredible amounts of AUM over the past few years. So these are big money right now. Now that AUM has come down a little bit because, of course, as the growthy area, which tends to be where these products seem to be concentrated, right? They issue them for areas that people like to trade. These are traders type things. People want volatility. They want MAG. They want tech. They want excitement. There's some on Bitcoin, Russell, things like that. But really, the bulk kind of goes into where the action is. So if you have an ETF. That is a 3-time levered version of this particular stock, which went from 100 to 110, right? It went up 10%. The 3-time levered version is going to go from 100 to 130, right? Now, okay, so So basically, you've got a stock trading at 100, it goes up 10%, takes it from 100 to 110. The 3-time levered version goes from 100 to 130, right? 3 times the gain up here. Now, let's say for argument's sake that the stock goes back to 100, right where it started. That is that is 9.1%, right? So $10 is 9.1% of 110. So it goes down 9.1%, which means the 3-time levered product goes down 3 times 9.1%, which is, let's take a look here, equals 27.3%. So where does that take us? Well, 130 times 27.3% is 35.49. So the 3-time goes from 130 to 94.51. Okay, so you see what happened here. The original one has gotten back right to where it started. If you own this one, no harm done. You're back to where you started. The levered product, following the performance of the underlying, which it has to promise 3 times the movement of, is going to go down to 94.51. So just on this move, when you start getting huge swings back and forth, just on this move, you've lost 5% of your original value. And so you take something like SOXL and some of these other lever products out there, MSTX, etc., on high-flying kind of areas, either themes or stocks like MSTR, things like that, you get a lot of up and down movement. So as long as this keeps going, so imagine that the stock goes back to 110. Well, this thing's going to do the same thing again, and then it goes down to 105, or it goes down to 95, right? As long as there's up and down hurt. So these products are short realized volatility, right? When you're short something, that means it hurts you when it happens. So realized volatility means just up and down, up and down, up and down, and that hurts you. It's cutting into your performance. Now, does this performance come back? Gone forever, right? This sort of leverage decay is gone forever. Now, the reason I'm mentioning it is because we talked about this a moment ago, which is these things had massive moves. So they have huge influxes into the underlying assets in order to maintain that leverage on the way up. But once they add a whole bunch of leverage, if you look at today's performance, now the S&P's down whatever it is, 2.5% or whatever. Now these things have to go the other way. Now they have to sell out what they bought up there. So they're getting chopped up. They're getting chopped up back and forth. So this was the largest size ever for a rebalance. And now when things go back the other way, it's going to keep happening. And so as long as these products keep moving around like this, and I'm going to do a video just talking about when you can trade these products more confidently, but right now isn't the time because realized volatility is through the roof, right? It helped you definitely. This one day would have been amazing to own these products. Some of them were up massive, but just so you know, if volatility keeps up, it keeps chopping these products up. So I hope that helps you guys, and we'll see you in the next one.
Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to Options Ninja. Now back to the video.